All right, guys. Sorry for the delay before this video. It's not really my fault. I wanted to start everything all over again for you guys, but then in a different way. I really noticed something. Most of you just keep asking me questions based on the strategies we've outlined before, but now I just want to like take it all over again. The same thing is going to be the same thing, but in a different way, I think. In a different way. So, all I will just request from you guys is attention. Pay attention to every single details of what I'm going to say. I will try as much as possible to point it out when I'm saying it so you see it that it happens in the market. I didn't make it up. So just pay attention to it. Right now, we'll be taking on everything we've done before, like I said, but this time in a different way. I'm going to make this a little bit bolder. Maybe, yes, something like this. So we are going to start with liquidity this time. It's not going to be supply and demand. It's not going to be other blocks like before. This time we are starting with liquidity. I'm sorry guys for the delay. I needed to plug in my system, so sorry. So we are starting with liquidity. Liquidity. I want you to understand something about the markets. And after liquidity, we will then do price cycle. I'm not going to go over the higher time trend cycle or and all those 5 days, 20 days price cycle. I'll just focus it on intraday price cycle because I really do not want us to like complicate things. So I'll just go over the price cycle, and this price cycle is going to be in the form of intraday cycle, intraday cycle, and daily cycle. Intraday and daily cycle. I will explain that with time as we go further. And then we are going to go over market structure. Of course, structure is everything. Structure is everything. And then we'll do premium and discount. Premium and discount. And then after that, we then talk about the efficient price delivery, efficient and inefficient price delivery, efficient and inefficient. That's just like fair value gap if you don't know about it, and inefficient price delivery, ED. Then go over zones like POI, which includes I think we should go over other blocks, breaker blocks, breaker blocks, um, rejection blocks. Do any other one, and then I think we should also go over SND. Yes, SND. These are just the ones we should be going over, like how to pick them. Not exactly how to pick them, but So far, so good. Well, it should be how to pick them, and then after we pick the other blocks and all those stuff, the next thing is the confirmation entries. In these confirmation entries, that's where we introduce the indicator I told you guys about, because I've really like back tested it, and it really helped. It helped. It helped me a lot in entries. Like recently, even the GBP USD trade I sent out this afternoon that I was still typing, and the price have already gone to hit 1:5. I think it was 3 pips stop loss, and then more than 16 pips take profits. So that was just it. I was still typing it, and then before I could even check it, it was long and gone. So it was the indicator. I use the indicator for the entries and all those. Even the first one I sent that played out and then didn't really play out well, and then came back and took us out. It happened. And then the next one that happened after it, all those things. So I will introduce the indicator, and then we do top down analysis. Top down analysis. Analysis. And then if you want to do any other, maybe 1 minute time frame trading and all those stuff, that's on you. But for now, this is what we should be doing. Everything I've listed here. And trust me, what you should pay attention more is this liquidity and this POI. Every other thing here falls under these two. Every other thing falls under these two. So for the purpose of this class today, we should be starting with liquidity, and then if time allows, and then I'll go over um price circle. The price circle. Sorry, this is not just price; it's price circle. Price circle means the circle. If time allows, we should go over the price circle, how to use them, where and where to find them, what to expect. What I mean by intraday price circle is what happens within a day, that's 24 hours from open to close. That's what I mean by intraday. And then what I mean by daily is what happens within a week, how price starts on Monday and how it closes on Friday. So those are basically what we should be looking at. I don't want to go over the 20 days price cycle or all those other stuffs. No, let's just concentrate on intraday and daily price cycle. And then the market structures. The market structure will definitely be on how to pick the correct highs and lows, because that's basically what we are looking for in market structure. If you can pick out the correct highs and lows in structure, you will definitely know your trend. So that's what we should be doing in market structure. And then premium and discount. Of course, you know what that is. Efficient and inefficient price delivery. You know what that is, but I will explain it better. And then we then go over POIs, other blocks, breaker blocks, rejection blocks, supply and demands, and all those stuff. And then the indicator I talked about, top down analysis. We can even go over 1 minute entry if you like, but for the purpose of this second, I should just call it marathon class. Please pay attention to the details I'll be dropping, because I wouldn't want you to come and ask me a question that I've already said in this video. I might not answer you. And then after this video, please, whatever class we are holding, make sure you understand the concept of this video first. I will only like explain something to you when you don't understand it. That's it. And then for the one-on-one classes, for those who still want to hold it, no problem. But for now, let's go over this. Like everyone knows, all of you, you know. If I ask you now, what's liquidity? You tell me it's where orders lie in the market. Of course, that's what we know about liquidity. It's where orders lie in the market. The forex market is the largest market in the world and in terms of liquidity. And of course, that's what most smart money traders don't actually understand. That this liquidity, it's what moves the market, not our zones. Liquidity is what moves the market. The market is not, it's subject to the laws of demand and supply, yes, but then liquidity is what moves the market. Why? If someone asks you why is liquidity moving the market and not the basic laws, you say the answer is very simple. It's because those who manipulate it or those who control the market do not want you to profit. If you are profiting, the banks shouldn't be profiting. They make money off your own losses, and then you make money off their own losses. Sometimes you don't even make money off their own losses. That's why there's a time in forex trading that says for someone to make money, another person has to lose. So that's just how this entire scenario play. All those classic patterns in the market, everything you pinpoint, everything you know about. Of course, they are the ones who controls the algorithm. They can manipulate it anyhow they want just to take it out of the market. Like they manipulate it in such a way that when you buy, they sell, and when you sell, they buy. He knows the advances. He knows everything. He knows where you are putting your buys. Knows where you are selling, and there is literally nothing you can do about it because he has something you don't have, and that is the insider. And it's actually very illegal to be an inside trader, like or they call it inside traders. Yes, that means having someone on the inside to give you or maybe heads up of what the bank is about to do. It's inside trading, so it's illegal. You can be jailed for it. I think I've had somewhere or seen something like that. So I think that is it. They know where you bought and where you sold. And on this basis, no matter what you try, he will always enter against you. The banks will always enter against you. Remember, because he has something that you don't. So if someone then asks you now, or let me just say that we've understood our beginner what liquidity is or what is the objective of the bankers or the big institutions. If you've understood it and then someone asks you what is the objective, you don't really know. The objective is just very simple. They will induce you to take a trade. I give you those classic patterns that you know in forex trading, chart patterns, support, whatever it is. They will induce you, take a trade, and then they will create panic within you. Like you really don't know if it's going or if it's coming down, but then they will create that panic within you, and all of a sudden, what happens next? They will hit your stop loss, sorry, and then force you into margin call or whatever it is if you didn't have a stop loss. That is just the main objective of this thing. What is it called? The interbank traders or the large institutions. That's their main objective in the market. They literally want nothing else. So, what you should understand about the forex market is that liquidity is the most important thing in this market. It's not SND, it's not other block, it's not rejection block, it's not PDRAs, it's not your liquidity void or the terms you guys use for it, the ICT traders. I've really talked to a lot of them and all those stuff. So it's not all those stuff that you know basically. It's not them. Those are not the things that move the market. They are not. The most important thing in this forex market is liquidity. So this is one thing that most of the forex traders, or let me just say smart money traders, Because I hope you understand something. Smart money is a very good concept. Not that it is the best, but it is a very, very good concept. And when I mean by good concept, I mean something that it's the only strategy I see that gives you this kind of precise entries that if you get it right, you are in for a huge profit. Like, right, you can literally make a profit of 1 is to 10, 1 is to 20 ROR with smart money. I'm not saying that the other concepts can give you that. It can. When I actually started Forex newly, there was this channel on YouTube I followed. Like, he'll tell you if he's going to take a trade, if the zone is 30 pips, he will place his entry and then 30 pips below the zone. And then that's not just where his stop loss is. And then there's this indicator that's called ATR, average true range. It actually gives you the volatility in markets and tells you like how many pips the market have moved within the last 20 or 30 candles, the average of it. So it's called average true range, like just to give you the range. The true range might be that the price have been moving 50 pips per candle, or let's say 30 pips per candle. Now he will also have to add that 50 pips to the previous 30 pips stop loss he has. That means 80 pips stop loss. And now what's his target? 1 is to 1.4. You know what that means? If he has a 100K account, he's risking 1,000 to make 1,400. That's $400 profit. So you can see that one loss will actually wipes out both his previous wins and extra, because he will have to win like 3 times to cover up one previous loss. So those were definitely the nonsense that you see in the market then. But it's not like that when you are trading smart money. You trade it, you understand what it is, and then that's it. So you should understand that liquidity is what makes the market move. It's not other blocks, not supply and demand. It's not rejection block. It's liquidity, because this is a market that moves based on price manipulations, and to be there, price manipulation in order to obtain liquidity. So after we understand that liquidity is important, let's move to the most important stage, which is how do we know where this liquidity is in the charts? This is the most important question people ask. How do we know where liquidity is in the market or in the chart, or like, okay, this is Euro USD on the monthly time frame. How do we know where liquidity is? I'm not going to use the play mode in this liquidity class. I'm just going to be pointing it out for you. So you see that everything I said happened. We could just keep going. I think we should just start it maybe somewhere here. We work it all the way down from monthly to daily to other time frames. Just let's I want you to understand something, how this works. So the funny thing about this thing, about you knowing where the liquidity is in the market, is that we don't nobody on earth, unless those who trade illegally, that's the inside traders. The truth is nobody in the market actually knows where the liquidity lies. Nobody. We can only expect where liquidity can be found, and there are potential places where liquidity is very, very large, and the probability of places where the liquidity is weak. So you have to know something now, that every top and bottom of a price movement is liquidity. What I mean by that is, if price makes this movement, something like this, a high, a low, sorry, if price makes this movement, a high, a low, a high, a low, a high, a low, a high, every single one of these, every single one of these tops, this one, this one, sorry, this one, and then this one, all of them, every single one of them, this low, all of them are liquidity. Every single high and low in the market is liquidity. If you went through my previous video, there was something I said about protected highs and protected lows. It's not because they are not liquidity, but the institutions got involved there. So they will protect it. They wouldn't want price to go below it because their own orders are there. So that's exactly how we avoid the liquidity areas. Don't worry, we'll get to that. We are just starting this all over again. Every single high, low in the market is liquidity. It's not just the basic liquidity stuff that we did before, the trend lines, the double top, and all those stuff. With time, we get to understand many things more in the market. Every single up and down in the market, all of them here, they're all liquidity. Liquidity, 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 liquidity everywhere. And what the algo is programmed is to always seek for liquidity. And you know the funny thing about this liquidity of a thing is that once price grabs important liquidity in market, take note of this. Once price grabs an important liquidity in market, it reverses. It will give a reversal. It could just be small movement or something, but price must definitely reverse. So the algo is built in such a way that it is always seeking liquidity. Even in an uptrend, if price grabs liquidity above any previous high or something, it will reverse and then seek for another liquidity below to continue the trend. If there is no liquidity below, price will create one. It will induce traders into it, like create a fake supply or fake support resistance and then clear that liquidity before heading up. Liquidity is like the fuel in the market, like it's what makes the market to move. And this is something that most traders know, that most smart money traders know, that liquidity is the fuel in the market. But then which of them is liquidity? Ask any basic smart money trader what the types of liquidity they will tell you. You hear them say double top, double top liquidity equal high, double bottom, double bottom equal lows, and then trend lines, trend line liquidity, or triple top, triple bottom, whatever it is that they call. But these are just the basic forms of liquidity. These ones, they are the basic. Every single high and low in the market is liquidity. Now, you should understand that when price grabs liquidity on the higher time frame, it will give out a much larger reaction than when it grabs liquidity on the lower time frame. That is one concept you should also know. Like liquidity increases with time frame. So I think we should divide this liquidity into, like, maybe we could say three or four types. Okay, let's just put it at three. We then have the higher time frame liquidity, the medium time frame liquidity, and then the lower time frame liquidity. And what I mean by the higher time frame liquidity, I'm talking about liquidity grabs on monthly charts, yearly charts, weekly charts, or daily charts, even swing highs and swing lows, because those are what we are talking about. They are the liquidities that we are talking about on the higher time frame. And then the medium time frame is something you talk about, the 1 hour time frame, because 1 hour time frame is one of the best trading time frames you can actually think of. It's not too long, it's not too short. 1 hour. That's what most traders actually use as their higher time frame, especially for 5 minutes scalpers and all those stuff. They use 1 hour as a higher time frame, and then 5 minutes as their entry. Some use 4 hours and 15 minutes. It all depends on the strategy you trade. There's no rules that say you shouldn't do that. But then if price grabs liquidity on the 1 hour time frame, it wouldn't actually be exactly as the liquidity, or it wouldn't produce as much movement as it will when price grabs liquidity on weekly time frame or maybe monthly time frame. So if you are looking at a monthly chart, because you will understand that when price is grabbing liquidity, it's grabbing liquidity in form of previous yearly highs. Like these are highs that have been in the market for years, and then price comes and clear them. There are definitely many stop losses or sell stops or buy stops resting at those areas, waiting for price to trigger them, either that it breaks above it or it comes down. Simple. It's just that simple. So if you pull up this chart like this, let's just leave it here. Pull up this chart like this and you ask yourself, where is liquidity? Where is every single liquidity in this market? Where will you point out? Okay, since we are not in a class, I will point it out for you. You will actually start from here. You will notice that this was a high and its liquidity. This was a low, its liquidity. Sorry, I'm going to mark it as liquidity, something like this. It's something like this. Anywhere we see this, anywhere we see liquidity, we'll mark it with this, and then notice something I said, that once price grabs this liquidity, it will reverse. And let's go into it so you understand that I wasn't capping. I was telling you the fact. I wasn't capping when I said it. I was telling you the fact. So this was a low. I think this was 19 August 1997. This was 1997 low. And then in 1999, it was grabbed. Although it wasn't really that important, but then price grabs it and gives out this little reaction up here. It gives out this little reaction, which is almost 801 pips. And then what happens? Price rallied down. I don't want to go over everything that happened here. And then it grabbed this previous high right here. This was October 1998. The high that was produced in October 1998, price came back and grabbed it right here. And what happens? It produced this reaction of 1,180 pips. I want you to just keep note of how everything is happening in the market right now. That, like I said, once price grabs an important liquidity, it will reverse. And what happens after that? Price now came and grabbed this other liquidity. This was another high. Price grabbed the liquidity. And what happened? We have this massive move to the downside. Price grabs liquidity and produce this move of 1,960, almost 2,000 pips. 2,000 pips price reaction. And what did it do next? It came back and grabbed this liquidity. Sorry, I will keep recording all of them as liquidity, please. I'm sorry. It came down and took this liquidity. That was the next liquidity that was cleared in the market. And then this rally up to the upside. What happens again? When price rallied up to the upside, it cleared out every single liquidity that have been in the market for a very long time. It cleared all of them, every single one of them. Price cleared them out. This was a massive liquidity clearance, producing the current high in Euro USD. This right here is still a liquidity that haven't been cleared. Anytime price comes for it, it will definitely reverse after it clears it. Let me just keep marking them out. This should be another liquidity. And then what happens? Price grabs it and then produce this massive reaction to the downside. So we'll put it somewhere here. What the fuck is wrong with this shit? And then we put it here. 3,765 pips reaction, market reaction. These are what we call the higher time frame liquidity once it is grabbed. If price grabs important liquidity, like I said before, it will reverse. What I mean by important liquidity, I mean something like, I'll highlight them for you. Important liquidities, this include um, previous yearly highs, previous yearly low, previous monthly highs, previous monthly lows. Now I have previous weekly high, previous weekly low, previous daily high, previous daily low, and then structural highs, structural highs, and lows. These are what we call the higher time frame liquidity. And then the lower time frame liquidities are those of, like I said, or maybe the medium liquidity are those of the 1 hour charts. And then the lower time frame liquidity are the ones you get from 30 minutes time frame down to 1 minute time frame. Like those ones, once price grabs liquidity in 1 hour time frame, when price grabs liquidity, it can produce something like maybe 50 to 100 pips movement. And then in lower time frame, you can get those 20 to 50 pips movement. If you're an intraday trader who actually likes 20 pips a day, 30 pips a day, 50 pips a day, you can concentrate on the lower time frame liquidity. If you are someone who wants a bigger liquidity movement or a bigger movement in price action, like the 50 to 100, focus on 1 hour. If you're someone who actually wants like much bigger movement in price, you can then focus on those higher time frame liquidities as I'm pointing them out now for you. So we keep pointing where liquidity is. So where is the next liquidity? This was a high that was produced December 2008. Of course, it's liquidity. Like I said before, price does what? Price grabs it and then heads down. What happens next? Price grabs this low. And what does price do? It heads up. That's basically how it is. That's what price will keep on doing. Grab liquidity and then move to the upside. Grab liquidity and then move to the downside. It will keep on seeking liquidity if there was none to be grabbed. I hope you know, like this, just watch this price movement right here. I will zoom it out. Watch this price movement right here. What happened? When price rallied down, there was no liquidity left. It left a liquidity right here that price came back to grab. But right here, price left nothing. It literally left nothing in the market to be grabbed. Even when it rallied down here, I hope before it reversed to the upside, it grabbed this equal low liquidity. This was still liquidity, of course. You mark it down. Like I said, every single high and low in the market is liquidity. This was liquidity. Price grabs it before this up movement. But then it left this high as liquidity. Everyone who was in this trade and who was trailing their stop losses must have actually placed it above this high. Of course, price is rallying down, they placed it above this high. What happens next? Price came back and cleared it. Cleared this high and then came down, cleared this other one. And then there was no liquidity left to be grabbed. Price then created it. Price created the liquidity itself. This was it. Induced everyone into this into shifting or taking the sell from there because of course we are now bearish or something like that. And then what happens next? It cleared it. Price takes the liquidity and then rally down. After it rallies down, what happens? It took this equal high, equal low liquidity right here, and then I'm going to point all of them till the last point, and then we go to another time frame because that's the That's the reason for this class. It grabs this other liquidity and then rallies up. Where's the next liquidity? All of them right here. This one is liquidity. Sorry. It grabs this liquidity. It was a high. This was monthly. This was February 2013 side. It came back and grabbed it on April. That's almost after 2 months or so. Price came back, grabbed the liquidity, and then dropped. And that's it. And then grabbed this impulsively. Notice how price is dropping with impulse because it has already grabbed enough liquidity as it's heading down. Grab this, grab this at the same time, and then grab this. This was another liquidity right here. And then this other one. These are all liquidities. Price then grabbed this other low. And what happened? After grabbing this low, it wasn't really enough. Like, of course, price have been in a high for a very long time. It wasn't enough to like take price up to fill all these fair value gaps and everything here. It wasn't really enough for price. And just notice what price does next. Of course, this was a zone that everybody is seeing. And what did it do? It created a very good support zone right here to induce everyone to take this buy. Of course, price have tested here once. Even if you extend it backwards, it will look something like a resistance. Even if you extend it all the way to this point, resist support broken, resistance came back, took it out, support, and then it's coming here to create support again. And then what happens next? Price clears out everything, clears it out. After grabbing this liquidity, you can actually know, you can check how many pips this is. Like this movement right here, all of you might be thinking that this thing is small now, but this is it. Almost 200 pips movement. It's 165 pips move. That's actually someone's target. And then price grabs all this liquidity. And then notice something again, that this actually looks like a double bottom at the start. Of course, price is in a support zone that have been tested many times, produce this double bottom, and then this is something they call, I think it's tweezer candlestick pattern. This was a tweezer with an inside bar at the same time, and then everyone is taking their buys, of course, and putting their stop losses here. What happens? Price grabs every single liquidity. I'm going to take this out. Price grabs the liquidity. It grabs this liquidity, equal low or whatever it is. Of course, we all know about it. Price grabs it, and that's it. Price grabs liquidity, and then heads up. What happens next? It needs to seek liquidity again to take out the market, to take the market down. It created the liquidity because there was none for it to grab unless it wants to come and grab this one, because that was the last high. Unless price comes back here to grab this one, it was the last high, but there was no liquidity for it to grab. So it created one, grabbed it, and then headed downwards. Price still haven't been able to find any liquidity down here to grab for it to continue up. So it couldn't actually break this side because there was no liquidity for this one to grab, even though it created one here by itself, and then taking it out. But this wasn't really enough for price to move down to, like, for price to take or rally price up. So what happens next? It still came down. Which one is it grabbing? This one. It's grabbing the previous low again, and that's it. Price will just keep on doing something like this forever. It will keep on grabbing liquidity. Like I said, once it grabs, just look at how we've dissected this price movement all the way from 1997 down to current day, like down to current day. Look at how we've dissected it all the way from here. This was 1992, pinpointing how price grabs liquidity, and once it grabs those liquidity, it will reverse. There is literally no other explanation for this. The algo is built in such a way that once it grabs liquidity, it will reverse. Like, it's not just liquidity, I mean important liquidity. Once the algo grabs important liquidity, if you don't know what important liquidity is, I highlighted them here for you. You can just go over it. Once it grabs those important liquidity, it will reverse. It will definitely reverse. Price, once it grabs liquidity, it will reverse. This was like, I'm still even taking it backwards just for you to see that this keeps happening every single time. Grabs this liquidity and then heads up. What happens next? They actually grab this one before, grab this and then rally down. This was liquidity right here. This was liquidity grabbed and then produced this movement. This was liquidity right here. Equal low, grabbed, and then price produced this movement. I could just start putting these price measurements. So you could all just start seeing it that once price grabbed the liquidity, it produced a movement in the market. This is it. And then you can just keep checking how many pips that is to understand that this is the concept that you should pay more attention to, and not every day looking for zones. What you should be looking for in the market is important areas that price took liquidity. You should be looking for them. Important areas that price took liquidity. This was the last liquidity that was swept by price, and this was 1989, June 1989's low. Price cleared this liquidity before this massive move to the upside. And this was actually more like how many years back? Structural low and everything. It was 1989's back, structural low. You can see this movement, rally base rally, structural low, and then price came and cleared it before this massive move to the upside. Like I said before, I will repeat it again. Once price grabs an important liquidity, it will reverse. It doesn't mean like it will change the trend, but it will give out a reaction. It will definitely give out a reaction. That is what the algo is built. That is how the algo is produced. Grab liquidity and produce reaction. Grab liquidity, and it is how it was made to always grab liquidity, seek liquidity, grab them, and all those stuff. This was the last one, and then this one to the upside, and then when price came down and grabbed this low right here, it then produced this, and then this then grabbed this high and then produced this, something like this. It's just a circle that kept on repeating this then, and then you could just start marking it out yourself and see how many pips it produced each time price grabbed liquidity. It doesn't necessarily have to reverse with that first candle that grabs liquidity. It might take the next two or three candles, but that's just it. This is on the monthly time frame. We go down to daily or even 4 hours to point out where price grab liquidity and then reverse. This is the purpose of this class. This is the concept we are starting with this time around. So, like I said, um, important liquidity is first, and then price will reverse. So, the next thing is I'll delete everything that I've marked out here, so we don't have to do it again. Just go down to the daily time frame and see what happens. What is price doing on the daily time frame? We just start from here. The same thing, liquidity grabbed, maybe here. Price grabs this liquidity right here, and then reversal, grabs, reversed. You grab this one, equal low, grabbed. It was just wicked out a little and then reversed. Which other one? Price then came down, grabbed this one. Sorry. it first of all grab this and then produce this reaction. That's just it. It grabs, it reverse. This is 186 pips. Price grab this and then produce this reaction. And then I'm going to take this out. Sorry. And then what next? You grab this one. Important. Important liquidity. It will grab. We are bearish, so we should also be looking for liquidity to be cleared to the upside before it will rally down. Grabbed it and then dropped. After it dropped, there was no liquidity for it to grab. So he created this one and then grabbed. And then to the upside, when it came to the upside, which one did it grab? Of course, when he created this fake movement, he created both a high and a low. This will actually look like a change of character. Of course, this is a change of character. If you even go down to the lower time frame, it's a valid change of character. But was it enough for price? It wasn't really enough for price. And then price came back and cleared out the liquidity. Of course, it was supposed to clear out the liquidity because price haven't grabbed an important liquidity on lower time on the downside for it to move up. It needs to, like this point here, price reversed. It must have grabbed an important liquidity. Could be this maybe, or this. Yes, something like this. I think if you look at it, it will actually look like an equal high. Maybe grab this and then it was important, then touch the demand zone and all those stuff. Please, I'm not going to like paint these like the way YouTube mentors or YouTube teachers paint it. I want you to understand what I'm saying, and that's why I'm taking my time to point it out. Every single one of them. Look at it, grab liquidity, and then to the downside. And then what next? Grab liquidity to the downside. This was a low, of course, this was a high, a low, another high. But then once price grabbed this low, it still gave out another reaction. It's just how it will keep on going. So price grabs liquidity, it will reverse, grabs liquidity again, it will still reverse to the downside. This was it. Grabs, reversed, grabs, reversed, and then grab this one, reversed, and then did it grab anyone here? Not yet. And everything just keeps on going this way. It will continue. Price will just keep on seeking for liquidity and then grabbing them, seeking for liquidity and grabbing them. This is the measure or the higher time frame liquidity. It could continue going down, maybe to the 1 hour, 1 hour time frame, where we seek the medium form of liquidity, the medium time frame. I'm not going to go over the minor or the lower time frame forms of liquidity. You can do that on your own because I understand that everyone here already knows what they are doing. So you can all go down and check it on the lower time frame, 30 minutes, 15 minutes, 5 minutes, 3 minutes, 2 minutes, 1 minute, every single lower time frame. You can go back on your own and check it. Once price grabs liquidity, it could be in the form of previous day or anything. And then this was liquidity, price grabs, and then reverses. And then this one, grab this. Although it didn't really give much reaction after grabbing this because was it maybe it wasn't really that important. It wasn't really that important of a liquidity, but it came down and grabbed this one. Of course, this was another low, and then reversed. Then what happens here? We keep checking to the upside. Price have grabbed important liquidity, but it wasn't really enough to take the price up. It wasn't. It only gave out this 72 pips movement. It wasn't, but then created a fake low. Price keep on doing it. It kept on doing this. Yours are right here. I'll just call it something like that. Create a fake low, and then came back and grabbed the liquidity, and then to the upside again. It wants to take price up, or maybe we don't really know. And then this movement, maybe. all the way to here. Sorry, another 74 pips movement. And then what happened? He then grabbed this one and then another movement to the downside. Produce this. Once you grab that one, it produces this to the downside. And then after that, price then grab this hanging liquidity right here and then rally to the upside. Rally to the upside and then cleared out this one, liquidity. When it cleared it out, it still came down and then grabbed this other liquidity right here. Sorry, I'll take this out. Grab this one right here and then produce this movement down here, sorry, up here, and then grab this one, grab liquidity to the downside, to the upside, buy side liquidity, grabbed it, and then came back for this, and then came back for this before this massive move to the upside. Now, when price moved to the upside all the way here, although it grabbed liquidity, but this liquidity was not enough for it to take out this liquidity that was hanging here. It wasn't. It was a major liquidity because of all these consolidations here. Of course, everybody is now buying, selling, and all those stuff. It was before it produced this movement, but this was 100 pips movement. Like I said, 1 hour time frame will give you that 50 to 100 pips. I didn't really measure this before I started. I just said it. This was 100 pips movement, but it wasn't enough for price to actually like take this other liquidity. Of course, you know that this is liquidity. Like I said, every single high and low in the market is liquidity. This is another liquidity. This was liquidity. It wasn't enough. So price now decided to do something. Induced everybody into taking a position here. Support. Created this fake support zone. Every single human being who was trading is now buying here. The retail concepts, buy here, sell here, buy here, buy here, buy here, bought here, stop loss here, bought again, stop loss, bought again, stop loss, bought again. How many times did price touch here? One, two, three, four. Like created a very strong support zone, a very, very strong support zone. And what happens next? It clears all of them. You can even start working it down from the upside. Even before price started coming down here, he cleared out this liquidity first. Of course, like I said before, every single high and low is liquidity. Cleared it out and then cleared this one, liquidity. Once it grabs important liquidity, it will reverse. Once it grabs important liquidity, it will reverse. This was Thursday's low, and then it was cleared on Friday. Thursday's low, cleared on Friday. Thursday's high, cleared on Friday. Both of them daily high, previous daily high and daily low were cleared on that day. Thursday, Thursday's high. It wasn't really exactly Thursday's highest high, but it was a high that was produced on Thursday and a low that was produced on Thursday last week. It was now cleared on Friday, and then price then dropped into this support zone, and then everyone is taking a buy, cleared the high, and then came down again, produced this one. I think this was Asian movements. Asian price open. This right here. Price grabs it. Of course, it wasn't enough because not many people were trading at this particular point. Grabs it, come down here, takes this one out, and then taps into this zone, and all of a sudden, they cleared out everyone here, cleared out every single human being here. And after they cleared them out, we have this move to the upside. Now, price haven't actually grabbed an important liquidity. It's either it grabs an important liquidity right here at the upside, or just watch out what will happen next. It's just the same thing. You can even go down to 15 minutes. I'll just clear out everything. So 15 minutes, and we can see also start pointing it out how it happens, structural highs and lows, what happens when price grabs liquidity and all those stuff. It's the same thing. It's basically the same thing everywhere. You can just keep pointing them out. It's the same thing. The same thing everywhere, every day. It keeps repeating. So that is how the algo is programmed to always seek liquidity. It traps you in such a way that you are only thinking about other blocks or zones, but then you are forgetting the most important fact, which is that the algo is programmed to seek for liquidity. This we have gone from the higher time frame liquidity to the medium liquidity and now to lower time frame liquidity, which is the 15 minutes. And we've even at the same time covered something about the retail concept, which is the forms of support and resistance and all those stuffs. And you can also see these beautiful trend lines that price actually, I think that was actually what price grabbed here before this movement to the downside. You might never know. Then you have this trend line that was grabbed and all those stuffs. It's just how traders see everything, something like this, of course, something like this. Price grabs, but it was actually a very large movement to the upside. So I won't really consider that. So if you are going to take a trade, I think you should start first from highlighting or maybe marking out important areas in the market where you think that liquidity might lie. It's not where liquidity is because you really don't know where liquidity is. So you have to point out where you think liquidity might be in. If you can picture it out, like picture those areas where you think that liquidity might be in, then you are in for a ride. So, since we've covered the idea of liquidity and how to find them, of course, combined with every single thing we've done before in liquidity, the equal highs, the equal lows, the trend lines, and all those stuff, the chart patterns, and every single thing that is happening in the market. You should understand it right now that when you are looking for liquidity, you shouldn't just be looking at equal highs and equal lows. You should also be looking at highs and lows. Now, the question that most of you will now be asking yourself is that, okay, so law, how do we know if price will reverse after it grabs this important liquidity or after it grabs liquidity? Don't worry. For the purpose of this class, we are going to take them one after the other. We'll get to that point. But for now, let's just concentrate on how you picture out this liquidity. So the next form of liquidity we should be dealing with is inducement. So what is inducement? Someone might just come in and ask you, what is inducement? And then what will you say? Most of you don't even know what inducement is. You just know it's anything. I don't know what you would call it. But then I will just give you a simple definition that inducement is just a liquidity that is close to your POI. So what I mean by that is if you have a high, a low, and then a high again, sorry, this is not what this price should look like. Sorry guys. If you have a high and then oh I'm just trying to picture how I want to make this look for you so you understand it. Let's say you have this price action movement right here, and then we have this. Of course, we know that price needs to grab important liquidity before moving to the upside, and then we now have this. Okay, so this is the price action I want to give you. Now, what happened first? We have this liquidity grab by price before this movement to the upside, and we now have this liquidity grab to the upside to produce this movement to the downside. Now, once price makes a move like this, it leaves a POI. of course, something like a demand and supply, order block, rejection block, whatever it is. You see this low that price made here without tapping into your zone. It's liquidity, and that is inducement. Now, if you when you are watching this video, make sure you pause this particular point and maybe take a screenshot of this, because this is one market structure that most traders don't really know about, or one market structure that all of you like neglect, or is just basic. But it's not basic. It's not basic. This is what we call high probability setup. High probability setup. Don't worry, we get to this. We get to that. Now, this now becomes inducement to this zone. It doesn't matter what price does next. But one thing you should know, that its price is coming for this inducement or this liquidity. It might come here and create something that looks like a support, and you will see me mark it as S1 and S2. If it's on the upside, to be R1, R2, something like that. We'll mark S1 here, S2 here, and then after that, it will grab it, tap into your zone, and then it will continue. This is just the basic concept of inducement. Now, in most cases, price might not even tap to your zone after grabbing this liquidity. Does that mean you were wrong? No. But if price is coming back, you shouldn't be taking this trade right here again, because it have already done its job. What price is coming for is not this zone, is this liquidity. It have cleared it. So that's why sometimes price will give a reaction, and then it will come back and then tap into your zone, gives a small reaction and then take you out. And you will like you'll be wondering, but why did it happen? My zone was right, my this was this, my that was that. Yes, your zone was right, but the price is not after your zone. It's not after the supply and demand. Price is moving, seeking for liquidity. So if price does this without tapping into your zone but clears out the liquidity above the zone or the inducements, just leave the zone and look for a new one. That is basically it. That is how price action is. That is what this class is all about. I wouldn't really want a situation where after saying all this, you now still come and be saying, I didn't see it, it was this, it was that. I'm picturing it out for you. I want you to understand it, that after the inducement, price will clear it out and then tap into your zone. So you see the reason why we always look for inducements above a zone, and why I will always tell you that this zone was not induced before price came into it. So we are not trading it. So this is it. Take a screenshot and then point it out. Inducement. So how do you even find these inducements in your market? In market, maybe let's just assume that this was a price action you were looking at right here. Of course, you know that this is your supply zone, even though all this choppy market, but this actually broke structure and it hasn't been tapped in. So this becomes your supply zone. And what happens? As long as this low didn't tap into it, it's an inducement. And pricing came back and tapped into it. That is basically it. The next one is this one. This was the next zone. It produced. And then inducement. I'm not going to use market replay mode, because I want you to be saying, I don't want you to look all fancy and then it to be as if I pointed all these things out before coming for it. Inducement, that is it. That's it. Cleared liquidity, move to the upside, and then inducement, cleared that inducement, tapped into this one. Same thing happened here. This year, cleared liquidity. This was the liquidity price grabbed. And then what happened? Everything here was inducement. Every single thing here was inducement. Every single thing here, inducement. And then price clears it out and then tap into the zone. So you see how everything is now shaping it together. From liquidity, we've now dived into inducement. Once price grabs importance, liquidity, it rallies to the upside. There's no two ways about it. Absolutely no two ways about it. So I think this is already how many hours long, and I might just be ending the video right now. And from tomorrow, it's 11:28 a.m. here. From tomorrow, I will continue from price action. I just hope you guys go and backtest this and then check it out and see if what I said is right or wrong. See you guys.